All right, there we go. And folks can hear me all right? The audio is okay? All right,
Yes.
great. Great. So yes, thank you all so much for joining. Today is sort of the second half of the AMA kind of series we're doing with the next egg. So as a reminder, the next egg is a
Hi.
program of, hello. It's a program of Lift Economy, and we're particularly focused on supporting folks who are interested in reimagining retirement more broadly, but then also thinking about how to move their money off of Wall Street into Main Street. So today's conversation is actually a follow-up from a conversation that we had back in December as sort of an introduction to values aligned investing. So I'm putting in the recording for that in the chat, as well as a sort of resources and offerings document we sent afterward. So generally speaking, let me go ahead and share my screen once again so I can show what to expect
On your radar yet.
also, as you're joining, it would be awesome if you could mute yourselves so we can hear the speakers, and I'll try to monitor that on my end too. But if you're not already muted, please do mute yourself. And then at the end of today's session, we'll have some time for Q&A. So of course, at that point, we invite you to unmute and join in. But let me share my screen once more. Okay. So here is why we're gathered here today. Just as I mentioned during our last webinar, just a kind of disclaimer that Lift Economy is a worker-owned cooperative and impact consulting firm. We are not registered investment, legal, or tax advisors. So everything that we're going to be talking about today is really for general educational purposes and is not intended to replace any kind of professional or advisory services you may solicit otherwise. And we, encourage you to do your own research and seek any professional advice you might need before making any investment decisions. So now that we've got that out of the way, I'm going to introduce our speakers and have them share a little bit more about themselves. So why don't we go ahead and start with you, Angela? Take it away.
Hello, everyone. It's nice to meet you. I'm grateful to be here today. My name is Angela Barbash. I'm with Revalue, and we are a registered investment advisor, but I'm not providing investment advice today personally to you, but happy to share what I have learned over the years and then some general education. And I've been an advisor for 20 years and very much consider the work I do to be applied anthropology within the finance sector. And looking forward to the conversation.
Thank you. Janine.
Hi, everyone. I'm Janine Firpo, and I am a longtime investor, which I'll tell you a little bit about. And I made a decision about 15 years ago to invest all of my money in ways that align with my values, starting with my cash. I retired from a 35+ year career in tech and the role that it could play in solving poverty in developing countries about 6 years ago, and ended up writing a book called Activate Your Money: How to Grow Your Wealth and Build a Better World. And I co-founded a nonprofit called Invest for Better, and we put women into courses to teach them how to invest for financial growth and well-being, and also put their money to work in ways they want to see the world evolve. So that's what I do.
Thanks. Jasmine, do you want to jump in next?
Sure. Hi, everyone. I am the Director of Impacts at Candide Group, which is also a registered investment advisor. Sorry, I'm just going to move to the next room because my partner is also talking on Zoom at the same time. I have been in the impact investing space for about 5 years now, but before that, I was an organizer. I continue to be involved in community organizing, specifically around financial activism. So how we move big money out of the extractive industries and into community wealth and well-being. And I'll pause there for now. I'll also say that I have a book coming out called The Financial Activist Playbook, which is really designed for everyday people who want to learn how to align their money with larger community movements. And I'll stop there.
Thanks, Jasmine. Over to you, Jenny.
Hi, I'm Jenny Kassan. I'm an attorney and advocate and ecosystem builder. My big passion is moving money into the vast majority of businesses that make our world a better place, but do not really have access to sort of the mainstream world of finance. I also have a book with the same publisher as Jasmine, which is called Raise Capital on Your Own Terms, How to Fund Your Business Without Selling Your Soul. And so I'm doing everything I can to try to support entrepreneurs with achieving that on a large scale. And I'm currently working on a project in Baltimore to create a place-based ecosystem to support those kinds of activities. Thanks.
Thanks, Jenny. Katharine.
Hi there, my name is Katharine Gilman. I'm currently in Durham, North Carolina. I'm honored to be the executive director for the National Coalition for Community Capital, or NC3 for short. We work to educate, activate, and advocate community capital, which I will describe more in a few minutes. I'm grateful for y'all for being part of this work. Thank you for being here.
Thanks, Katharine. And last but certainly not least, Taj.
Good to be with you all. Taj James with Full Spectrum Group and Full Spectrum Capital. And our work is around supporting capital stewards and community stewards to come together in ways that build community wealth. And for 20 years, I ran an organization called the Movement Strategy Center. And the other work I do in this space is through a project called the Good Life Pledge, which I started with Kat Taylor from Beneficial Bank to help shift more assets and resources back to communities and places that have experienced extraction. So good to be with you all.
Thanks so much, Taj. And my name is Nairuti Shastry. I'm calling in from South Bend, Indiana. And yeah, just really thrilled to be joined by this all-star panel here today. So as we're kind of sharing a little bit about what we're covering today, if folks want to go ahead and use the chat to introduce themselves, we'd love to know where you're calling in from and maybe one thing you're hoping to gain out of our conversation today. And as those chats are coming in, I'm just going to quickly go over what we'll be talking about today. So Taj is going to start us off with some guiding questions, particularly related to due diligence for values-aligned investing. We're so excited to have Katharine here in her new role with NC3, and she'll be sharing a little bit about the principles of community capital as a sort of framework to help guide the conversation. And then we've got 4 incredible humans sharing their own investment stories. So we'll hear from Janine, Jenny, Angela, and Jasmine. And then at the very end, we're going to have ample time to talk through any questions that you might have as you're joining here today. I've got a few on stack based on submissions that folks had before as they registered for the event, but we really want to kind of be responsive to the questions and conversations that folks want to have here today. And again, we had over 100 people register for this event, and I know we've got about 40 folks here now, and folks coming in through the waiting room. So thank you so much for joining, and it's always exciting to see so many folks who are interested in sort of reinvesting our money in places and communities where it really matters. So thanks for joining us. Taj, would you like to kick us off and kind of ground us in this space today?
Yeah, just so honored to be with all of you and the amazing group of people who do really incredible work every day to democratize and make accessible our ability to align more of our resources with our values. And I think that's why we're all here and what brings us together, that this is a community of people who are trying to think about how we align our power with our purpose right? And that may be our social relationships, our political capital, but also whatever access we have to economic capital. How can we live in a way that the resources that we steward are helping to take care of our families, ourselves, the people that who depend on us, and can do good things in the world. And it's an exciting time to be in that conversation. So I think what you will find, if you read any of the 3 or 4 books that were just mentioned, which are all good places to kind of get education and learning about this field of community wealth building and shifting resources to Main Street and kind of shifting the way our economy works in a way that can help all of us to thrive. That those books and resources and the people who've written them are really huge assets for folks who are on the journey. So, and this is one of the questions that people might be asking is like, can I read a book and just figure it out myself and do it myself? And there are ways that you can DIY a lot of this with support from people here. And there's some questions you really want to ask yourself as you're coming into this conversation to see kind of what level of support you might need. So often in a process like this, the conversation starts with just what matters most to you. What's your purpose? What are your passions? What's the change you want to achieve in the world? And really having a clear sense of your purpose and your North Star is the key clarity that will allow you to navigate an environment that has a lot of options and a lot of decisions to make. Just really getting clear about your purpose. And then the next question really is like, well, what do I need to thrive? What does my family need to thrive? What do we really need? Because on a resource basis, some of the resources you're gonna direct purely down the path of purpose, meaning these resources are just about the impact that they're going to make in the world. And some of the resources that you are putting out in the world, you actually need to come back to you, right? And you need to know whether you're putting $1 into the world that's just going down the impact road and it's going to go as far as it's going to go, and if some of that needs to come back to you. And if you are in a situation where some of it needs to come back to you, that's where it's really good to reach out to someone like Angela, who's a registered investment advisor or a certified financial planner, to help make sure you've got someone who is aligned with you on the impact you want to make in the world, and they really understand the needs of you and your family so that they're guiding you. So if there's resources that need to come back, you can have some confidence that resources are being invested wisely. So I think that's just sort of an overall context for this in terms of knowing what kind of resources you have to work with, and why you're investing. So often in the work that we do, we kind of walk people through a process that has kind of 5 questions to it, right? First question is, what do I need to thrive? What is enough for me, for my family, for our organization, for our foundation, for our company? Like what are the resources that we need to sustain us in the work that we do? And having real clarity about what that is and what the scale of resources are, right? The next question that people often ask themselves is, the money that I have invested, how do I make sure that it's not doing things I don't want my money to be doing? Do I know where my money is? Do I know what it's doing? And how do I make sure it's not doing things I don't want it to do? And generally that's a conversation about divestment. How do I make sure that I pull resources out of places where my money is doing stuff I don't want it to be doing, right? Which is often where people start in the impact investing journey. The third part of the cycle for us is really what we call return, which is about acknowledging that our economy has essentially been built in such a way that communities and people have had land and resources taken from them unfairly. And sometimes we're in a position to shift resources back, to return resources back to communities and people from whom they've been extracted. And then that's an important thing to think about when we're stewarding resources that really are about impact. The fourth question is about shift, and this is often for those in the impact space who spend a lot of time figuring out within public markets with publicly traded companies, how do I make investments and securities that, do good stuff and don't do bad stuff, right? And that's really about sometimes what we think about as the Wall Street economy. And for those of us in the impact space who've been in it for a while, there's a recognition that like there are limitations to what you can achieve through public markets investing, significant limitations. And if your desire is for deeper and deeper impact, you've got to figure out how to make that shift and shift more of your assets from Wall Street to Main Street, right? And so figuring out what the balance of your capital allocation is between Wall Street and Main Street is one of the places where in your overall strategic thinking about your capital management, it's one of the things that Angela and other RAs will help you to do as you're figuring out how to balance those things. And that's sort of, in a broad sense, some of the kinds of considerations that if you work with a RIA or a financial planner, they're going to walk you through some version of those steps to help you figure out a strategy. We sort of wanted to lay all that out because today we're going to be spending most of our time and you're going to be hearing from folks sharing like how do you evaluate a specific investment opportunity, right? Which in a portfolio you may have, or maybe many investments in a portfolio, but we're going to be talking about kind of how you assess whether an investment is aligned with the impact you want to make, it's doing the things you want to do, it's going to perform financially in the ways that you might expect. But all of those individual decisions happen in the context of a broader investment strategy. And so we wanted to lay out what some of the considerations are as you think about how to build a strategy for yourself. So I'll pause there and turn it back to the team to take you into it further.
Awesome. Thank you so much, Taj, for that grounding and some of those helpful questions. I've tried to summarize them in the chat so folks can reference them as we're hearing from our storytellers today. And before we get started with that, I did want to pass it over to you, Katharine, to share a bit more about sort of the principles of community capital, which I understand to be a sort of helpful guiding framework in answering some of the questions that Taj just laid out for us. So over to you, and I'll share my screen for that slide too.
Awesome. Thank you, Nairuti, and thank you, Taj, for framing some of our questions. So as Nairuti shared, to ground our discussion, we wanted to begin just by clarifying what we mean by community capital and the principles upon which community capital is actualized. So our definition of community capital is the broad engagement of all community members in local investing. There are many strategies available for any individual to do this, some of which we'll hear a little bit later on today. But all of these strategies are joined by the following 4 principles of community capital. So community capital is inclusive, meaning it aims to empower all people to invest and grow their wealth while benefiting their own community. It also aims to empower all community builders and entrepreneurs to seek investments and launch their ideas with local and resilient support. Second, community capital is fair and equitable. It strives to be accessible and accountable to all shareholders, providing equitable returns for all and educating all about relevant factors and risks. Number 3, it empowers and serves all stakeholders by incorporating the perspectives and interests of all in the design and management of the investment opportunity. Finally, community capital facilitates shared prosperity. Community capital works to grow wealth and well-being for local individuals and communities. We see and work to perpetuate the flourishing of all through mutually beneficial investment practices. So with this, I want to pass it along to our panel of storytellers to share their experiences in realizing these goals of community capital through their own local investing.
So I think I'm first up. And when I had put together some thoughts for this, I was planning to speak to the private investing space, and I am going to do that. But in reading the comments, I'm noting that a lot of you are talking about how do I do this across my entire portfolio? So I want to speak to that a little bit as well. So first of all, I started investing when I was around my late 20s. which is like 35 plus years ago. I'm not going to give my exact age, but it's been a long time. And the bottom line is starting young. I started in the stock market because I started buying individual companies in the stock market because at the time that's all there was. And I also started in real estate. And what I have learned over time is that there's a lot more investment opportunities than I ever thought before. I didn't even hear about private investing until about 10 years ago, which is sort of shocking. But when we look at traditional investing and how we're normally taught to invest, we're taught about the stock market almost writ large. And so I think it's really important to realize that this kind of investing you can do in every single asset class we're talking about. And that's what I talk about in my book. I go asset class by asset class. The very first place you can think about investing in your community is where you bank. Because if you're banking in a large bank, think about what they're doing with your assets. You can move your assets to a community bank. It can be just as safe as in a large bank, and you can be actually influencing your community. You can invest in your community or other communities through bonds, through municipal bonds. So there's a huge opportunity in the bond market to invest in your values and invest in your community. Taj talked a little bit about the stock market. I said that I started investing there in private companies. You can still do diligence on private companies and make very positive kinds of investments there. I shifted out of that though, because it's a lot of work to invest in private companies. And when index funds became a thing, I started investing in those. And I started investing in things that I look at now, and I'm really disappointed in the impact they're having in the world. I use tools like As You Sow, Invest Your Values, to research this. And I'm now in the process of slowly moving my capital into things that I care about and that are better for the world in the stock market. But because I started investing so long ago, I have a lot of capital gains, and I have to do this very slowly. So if you're young, start right and put your money in the stock market in things that matter to you. Even if it's not perfect, it's better than a lot of the stuff I'm invested in. When I started hearing about private investing, I was afraid to invest that way. It's not something that women in particular are told about. I didn't know anything about it. And so I decided to start really small. I decided I would invest. My first investment was stuff that I felt pretty confident that I could lose. And that's a good thing because I lost it really fast. I heard about a company that I thought was so aligned with me. I was super excited about the entrepreneur. I did virtually no due diligence at all. 3 months after I made that investment, I found out that another company in exactly the same business had just raised $30 million. I didn't even know they existed because I never did a competitive landscape analysis. 3 months after that, I lost all my money. The company I invested in went out of business. So I decided, okay, I need to do this a little bit differently. I'm going to align with other women who are smarter than me at all of this. And so my next set of investments were through funds. One was called the Rising Tide Fund. It was made up of 99 women who invested $10,000 a piece. We raised $1 million, and we co-invested together in 8 or 9 companies. We don't know the results of that fund yet, but I don't think I'm going to see my capital back, all of it, and I don't think I'm going to get any return. I joined another group called Next Wave, invested through them. I learned so much investing through other women, and with other women, it was so much fun. I learned so much about angel investing, and I'm losing a lot of my money. I think I will eventually come flat, but it's really important to recognize that angel investing is really risky, and particularly equity investing is private equity. If you invest in 10 companies, you are looking for one that really has a hockey stick kind of growth curve. You've got to expect that a lot of your companies are going to grow at a slower rate. Some of them are going to flatline, and some of them are going to go out of business. So you just have to expect that. And I'm starting to see a lot of the companies that I invested in going out of business or flatlining. And we have a couple that we think are going to do the hockey stick. So I think we'll eventually come out all right. But it's a long-term game. I'm in it for 10 years. And I'm looking at my investments. I've also done some private investing, some of in debt. Some of my favorite investments actually came through Jenny and work that she did. So I heard about people that were looking for revenue-based or alternative non-equity kind of investing, and those investments have done really well. So where I am at this point, when I started out, I thought I'm not going to put more than 5% of my total net wealth in this kind of investing. It's just too risky. I am now moving toward a 20% allocation to this kind of investing, but most of it's in debt. So I've started investing in private debt funds where other people are making these decisions and I'm not. I've learned that this is a huge time sink, can take a lot of time. The other thing to really think about when you do a lot of local and private investing is how you keep track of your investments, how you keep track of what you invested in, what the terms are, where the deal sheets are, all of that stuff. I started redoing my will and realized, oh my God, when I die, this is going to be a nightmare for my heirs. They don't know anything about where any of this stuff is. And so I moved capital into an SDIRA, which is a self-directed retirement account that lets you invest this way. And that way, and I'm using that vehicle as my way of investing in private deals because they're keeping track of all of this information. So it'll make it much easier on my heirs when I pass away to know how that money was invested. So I've learned a ton along the way. And I'm happy to share more about that, but it's been a fascinating journey. I highly recommend private investing. Just realize that it's going to take time and start small and do it with other people to learn. And don't discount debt and revenue-based investing and alternative forms to equity. It's really
Yeah.
So I'll pass the baton on to our next storyteller.
Awesome. Thanks, Janine. So like others, I have to start by making explicit that what I'm sharing is purely educational, not providing investment advice. The personal investment I'm going to be talking about is one that I made a small personal investment as an individual, and that I mentioned in my forthcoming book, The Financial Activist Playbook. And it's one that in 2021, the Registered Investment Advisory where I work, Candide Group, would end up facilitating larger mission-aligned investments on behalf of some of our accredited investor clients. So you are always welcomed, if you are so inclined, to check out our website at candidegroup.com for full disclosures and other fun stuff. So that being said, now to my story. So I'm very early on in my journey. I appreciate Janine saying kind of really encouraging folks who are younger to start their journey kind of wherever they are. So I am in my late 20s, and I'm learning ways to invest in my community without needing to be an accredited investor. So I moved from New York where I was born and raised to Oakland, California, a little over 5 years ago. And it's very much home to me now, but for the first few years, I spent time really understanding what it meant to be a resident of such a historic but changing city. So through building community socially and beginning to build financial stability personally, just through work, I started paying attention to the ways where my dollars could align with collective wealth building and well-being. So exactly to Janine's point of just looking at all of my assets, what is my money actually doing? So, for example, I opened an account at Self-Help Credit Union, which uses my money to invest directly in the community instead of in industries like fossil fuels and private prisons that I'm fighting against in my workday. I started mapping out the local restaurants and stores that were owned by and supporting residents of color. I should also note that my fiance and I have the incredibly and increasingly rare privilege of owning the condo we live in, which he, as a Black Oaklander who was born and raised here, had the foresight to acquire and pour a lot of love into years before prices skyrocketed. So in general, we spent a lot of time understanding our local financial system that's led to this moment of gentrification and increasing inequity, and trying to be good stewards of our neighborhood and local economy. So my first official, so those are ways that I was kind of activating my money. That was, before kind of stepping into the role of official investments. But my first official community investment was in a very beloved local cooperative called East Bay Permanent Real Estate Cooperative, or EBPREC, which for years has been organizing with tenants and community groups here in the East Bay to address the worst elements of the housing and development crisis. So they do this by buying and preserving East Bay real estate to keep tenants of color in the community, remove housing from the speculative market, and publicly address the root problems of poverty concentration and general neighborhood disinvestment. And they do this through really accessible language and just ways of showing up in community and being, among community that empowers everyday people to organize, actually finance, acquire, and co-steward land and housing for the long term. The way that they do this to allow non-accredited investors to participate is EBPREC has something called a direct public offering, or DPO. And so folks may know the term IPO, initial public offering, is when a company offers shares to the public through a stock exchange, while a direct public offering, or DPO, involves a company offering shares directly to investors without the involvement of intermediaries like investment banks. But for this DPO, EBPREC offered $1,000 price shares. So each share is $1,000 for people to buy in as investor owners. And importantly, which was, I think, something that I was really drawn to, is regardless of how many shares someone buys, so if you have 1 share or if you have 20 shares, every community investor is granted a single equal vote in governance. And that's really consistent with, folks may know, kind of broader cooperative principles of 1 member, 1 vote, and the kind of cooperative governance movement internationally. And so this gives tenants and investors alike the opportunity to flex the muscle of cooperative co-ownership and co-management, even if they have no prior experience investing in assets like real estate. And the offering circular that EBPREC files and updates with the SEC has kind of all the information about the details of the investment for investor owners. But the one kind of quick thing I'll share is that this is what will be seen traditionally as a low return investment, right? And so as an investor owner, I'm offered a 1.5% annual dividend, which I elect to circle back into the fund rather than take out and use as income. But the reason that I bring up this example of a low return investment is because I want to challenge the conventional notion of risk and return here a little bit when it comes to community investing. So I'm in a unique position as a professional working in the impact investing space. I spend a lot of my time on a weekly basis diligencing investment opportunities for our ultra high net worth clients, family foundations, et cetera. And I diligence from the perspective of impact beyond just short-term financial returns to those shareholders. So the questions that I ask in my diligence include, what is the risk of not supporting this investment to the community in which it is, right? What is the risk of the failure of this investment and its mission to actually achieve its goals, and the risks that the community members of that place are currently experiencing? Also asking questions like, what are the potential returns to community members that have otherwise been elusive beyond financial returns, in which investment opens a new portal for real change? And so one example, coming back to EBPREC, they've really been focused on the past few years revitalizing the historic Black business district here in West Oakland, starting with this corridor called 7th Street. And this corridor is something of a case study for all things urban blight when it comes to federal implementation of urban renewal policies, demise of good jobs through things like shipyard employment, repossession and destruction of Black-owned property, through eminent domain. I saw someone mention eminent domain in the chat, and construction of a raised railway literally right over 7th Street. But before that, it was lovingly, it still continues to be lovingly remembered as something of a Harlem of the West. So 7th Street as a corridor was this really illuminous, bustling street in which there were businesses and restaurants and jazz clubs, especially in the 60s, that catered and were owned by Black locals, many of whom were residents by way of the Great Migration, and regularly hosted, famous greats like Etta James, Aretha Franklin, Duke Ellington. And so one of these jazz clubs was Esther's Orbit Room. And that has sat vacant for decades, essentially. until September 2021, when EBPREC was able, through their DPO and working with accredited investors, to purchase the property and officially put Esther's back into the hands of community. I could spend like hours talking about how exciting and how much of a joy it's been to watch the kind of development of Esther's Orbit Room over the past few years, but at a high level, it's a 3-parcel mixed-use Black arts venue that includes housing, commercial and event space, and is soon going to be the home for artist residencies, food services, and community events. And actually, it has already begun having some really vibrant community events. Last I checked, there's 370 of us investor owners, and EBPREC has successfully been hosting community gatherings, happy hours, organizing sessions for everyone from youth to elders, where people come together and really co-design and co-imagine the best uses for the space, but also for the neighborhood, right? And I mean, I'll just end by saying the last time that I was able to go down there, it's about 10 minutes from my house. I met an elder who still lives in the community and has lived her entire life in the community, which again is increasingly rare in gentrifying communities, but she couldn't stop smiling because during our tour, she remembers sneaking into Esther's as a little kid. She had her first drink at Esther's and watched the jazz musicians, right? And also saw all the devastation of what happens when extractive financing comes into a neighborhood and doesn't preserve its legacies and doesn't care about the actual people who live there. So to just kind of walk through that space with her and realize that like even my small $1,000 investment is a part of this larger collective revitalization, and it's already returning dividends for a community. It's to me as a resident, as someone who, you know, wants to feel like safe walking down the street, who wants to know my neighbors, and also just helping me build the confidence as a community investor, and really deepening my commitment to go deeper on this journey. And yeah, kind of ride the waves like Janine was talking about, the ups and downs, but overall just approach it as a kind of collective learning experience in which the financial return is one aspect, and one aspect that's important, but that we don't have to navigate alone. So I'll stop there.
I'm so glad you shared that story. That is such an amazing story. And just as a lawyer, I'll just mention they did use this thing called Regulation A, which is a nice tool. We also have regulation crowdfunding, and I'm happy to answer any questions about those securities laws issues later if anyone has questions about that. But yeah, it is absolutely possible for anyone to invest in whatever they want to. There are securities laws that make it possible, but it's especially amazing when the business goes through the trouble of doing the legal work that makes it possible for a large number of folks of any level of wealth or income can invest. So I love that story. My journey also started in Oakland in a different neighborhood called Fruitvale. I was working at a nonprofit there, and one of my jobs was to work with the small businesses there. And I just, got really frustrated when I saw how incredibly under-resourced they were, all the challenges that they faced. And yet, we're such an important part of the community. I mean, our small locally owned businesses are so essential to our quality of life, the health of our communities, the resiliency of our communities. I mean, with the Baltimore Bridge collapse, it just reminds us once again how when we are dependent on the global economy with multinational corporations shipping crap all over the world, like that is not a sustainable way of living. And if we don't have small local businesses of all different kinds, I'm not just talking about retail businesses, but all those businesses that create things locally, sell things locally, provide local services, just bring that diversity to our local economies, we are screwed. So I found out about the world of finance through a colleague, and started to look into, what is it, why is it that these businesses are so under-resourced? So went on a long journey to learn all about securities law, started helping small businesses raise capital. One of my very first clients was actually in West Oakland, which is the same neighborhood as Esther's Orbit Room, which it was called Community Foods Market. Before that, it was People's Community Market. And I helped them raise money also with $1,000 minimum investment, They raised several $1 million. Unfortunately, with COVID, they did not succeed, but that was just so inspiring to see so many people from all over California investing in this business. And it was a high risk investment. And you know, the even in the best case scenario, people would probably not make a huge return and they'd have to wait. They were told, you know, you probably won't even see a dime for 7 years. And yet, you know, a lot of people came in and invested. So that's kind of what I tried to start doing with my own investment dollars, just, you know, investing based on my passion and not necessarily doing a ton of due diligence, but, you know, based on the passion of the entrepreneur and the belief that I had in what they were doing. And yes, I will acknowledge I've made many small investments, many have not paid back. Many of the businesses have failed, but I never invested more than I could afford to lose. You know, I sort of set aside a portion of money that I felt like, you know, if I lose this, it would be okay. And so I think it's really important if you have the wherewithal to do that, because where else are these businesses going to get funding? I mean, they are perceived as risky. Sometimes they're not all that risky, sometimes they are, but they certainly don't have access to the funding that is out there. Even the funds, you know, we are here, especially after George Floyd was murdered, a lot of talk was happening about, oh, we're going to create all these funds and we're going to invest in, you know, Black owned businesses, people of color owned businesses. And yes, some of these funds do now exist. However, oftentimes the funds have really difficult criteria to meet, and most of the businesses that need the money are not able to access it. So that's why I'm a huge advocate of direct investing. If you can possibly take, you know, some people believe that investing in a fund is lower risk, which may or may not be true, but if you know of a business that you want to support that needs funding, consider a direct investment instead of a fund. So I started doing some of that type of investing with my own money, small dollar amounts. I also co-founded with Lift Economy something called the Force for Good Fund, where we raised a really small fund and invested in 13 businesses. And we made explicit from the very beginning, we aren't going to be investing in businesses that would be perceived as risky investments, because we don't want to replicate what a bank does. We don't want to only invest in things that cannot fail, because then we're not putting our money towards the things that you know, where it's most needed. And unfortunately, our portfolio hasn't done super well, to be honest with you. And of course, part of that was COVID. But you know, I don't regret it. And none of our investors, we have about 130 investors. I really haven't heard of any of our investors complain about the fact that they will probably not, they will get some of their money back. They already have. They probably won't get a full return. But you know, no one's complaining, because even though we're not getting a financial return, we know our money has done good in the world. And of course, I don't want to imply that we can't, you know, make good returns. It's such a funny coincidence. Yesterday in the mail, I got a check from an investment I had made a while back. Oftentimes I don't even remember some of these investments I made. Oh my God, yesterday I got a check. I got a great return on this small investment I made through a public offering under with a crowdfunding campaign. So, you know, it's not to say you can't get a great return, but, you know, let's definitely think about where the money is needed most, and what risks we can afford to take with our money, and what we want to see happen in the world. And, you know, even if our money doesn't end up coming back to us, it's not necessarily a loss. I mean, that money went out into the community and did something. It did good in the world. What else did I want to say? So I am a big believer in relationship-based investing. There's some research that I just heard about, and I'm curious if others have heard about this, by someone named Raj Chetty. And they did these analyses of what factors are most likely to lead to economic mobility. And they measured all different things like racial segregation in a community, you know, quality of schools, things like that. And interestingly enough, the thing that they found that had the biggest impact on economic mobility, in term meaning like someone's ability to increase their level of wealth and income over their lifetime, is, oh, thank you for, yes, that's exactly the article, is what they call economic connectedness, which basically means cross-class friendships. So to the extent that if you're a low-income person, you have relationships with people who have more financial resources, that is the thing that most predicts your ability to increase your economic well-being. And so I'm just so excited about that idea. And so I'm working on a place-based project right now where we can help to grow cross-class relationships and also grow cross-class investments. So people can come to this building, learn about investment opportunities in their community, and invest in businesses that normally wouldn't have access to capital. And the whole reason why I think it's important to have a physical building place where people can come and do that is that's how you really build relationships, is by meeting face to face, you know, getting to know people over time, creating friendships. Pretty much every investment I've ever made outside of my retirement portfolio is based on the relationship, the passion I see in the entrepreneur, the excitement for their mission. So I will stop there.
Thank you, everyone that's gone before me. It was great to hear your stories, and I've known Janine and Jenny for a while now. Jasmine is new to me, but it was cool to hear a little bit more of the background and context. So for my context, the context of my story, it's helpful to know that when we talk about investing in entrepreneurs or communities that are kind of entering the world from a place of disadvantage economically or socially speaking, that I am one of those people. So I came into this not knowing anything about money, came into adulthood understanding only what bankruptcy looked like and not understanding what investments looked like at all, even though I was quite proficient with math and a great student. Personal finance, as we all know, is not taught in secondary education, which is a real shame in this country. So coming into my 20s, I actually became a financial advisor so that I could learn about how the capital systems work in an effort to make change, positive change in the world, and came to understand pretty early on that if I didn't understand how the money systems work, then I wasn't going to be able to affect change in local government or in the nonprofit sector. So I just dove in, not knowing anything about anything when I was 23. And I bought a couple of stocks for myself in those early days, both of which did not go, well, they went bankrupt, but then reissued new stock. So all the original shareholders got wiped out, and then they put brand new shares out on the market, which I thought was an entire injustice unto itself, how they could use the legal system that way to restructure. So I got burnt pretty fast and decided to not go into the public markets again, even though I was advising people and educating them and helping them construct their portfolios. I understood that there was a clear difference between my values and my inclinations and their values and their inclinations. So it wasn't until I'm in my mid 40s now. So it wasn't until about 10 years ago that I started picking up investments again. And I started with my own business. And I think that is often an overlooked portion of people's portfolios. And that was done through lost wages of having concessionary income in the early years, or deferring my income so that employees could be paid more, be paid living wages, and then the actual capital outlay. And our own business raised community capital for our startup funds as well. So in the interceding years of the last 10 years, I have picked up a handful, probably about a half a dozen community investments outside of our business. We've acquired land, we've acquired precious metals. That's like zombie apocalypse money. We've invested in farm equipment. we've done a lot of things that are not even typically talked about in the community investment world, but like the land purchase was for soil restoration. And so now today, I did a quick kind of back of the napkin math. We only have about 6% of our assets in the public markets. And that's really SEP IRA money that we needed to defer. And it's not a large enough amount of money to justify the headache of self-directed IRA custodian, because I see how that plays out for people every day. So I'm not super excited about that. And it's as impact oriented as it can be for us in the public markets. On the private markets outside of our business and those other types of assets that I mentioned, of the half dozen that we've done, the thing that I've noticed that I'm gravitated toward are efforts that are creating access to opportunity for workers or for beneficiaries. An example of that is the Viridian at County Farm project in Ann Arbor, Michigan, which was in the sister city, a very affluent city next door to us where the University of Michigan was or is. And I thought it was a really fascinating deal. They put this plan together 4 years ago now, and now construction's happening, and the ball is rolling. But they essentially got the land gifted by the city for $1. They partnered with it's a mixed income neighborhood that they're creating, and they partnered with a local nonprofit that has transitional housing for chronically unhoused people, and that nonprofit wanted to create a permanent residency for these folks so that they could become homeowners over time in a lease to own structure. But they wanted, to Jenny's point of mentioning that study, they wanted them to give them the opportunity of cross-class neighborhood environment where there's a childcare center in the middle, there's a farmer's market in the middle, and the entire neighborhood is a net zero neighborhood that is 100% powered by by solar, and no gas lines are running at all. And the way that they opened the opportunity for the folks that working with the nonprofit was by having the for-profit entity do the capital raise and acquire or do all the build out. So they essentially, as an investor, I'm subsidizing the infrastructure cost for the nonprofit. And otherwise, that deal is completely impossible for the nonprofit. There's no way that in a affluent, high cost city that's going to be realistic. So it's those kinds of efforts that I'm willing to put more dollars into. And then sometimes I'll come across like an entrepreneur that was opening a wine bar in California, and I was like, yeah, sure, let's do $100, let's go, right? And it's okay if I don't get that back, because to me, that entrepreneur is more likely to have spent that money with local entrepreneurs of color in their network for services. So I know that cash got redistributed in a community that I'm going to feel good about, even if I don't see that money back. I think the challenge, and I'll make this my closing comment here, I think the challenge is for, and I see this on a day-to-day basis, is for investors who really do need to get this money back, that this is fueling their long-term cash flow needs. And I think in those cases, that there's a next ring out of investments that are income producing real estate, municipal bonds, banking locally with good interest rates. Like, there are less risky things that could be done that could arguably still be in a community investment sleeve or kind of an impact orientation. So I'll pause there, and then and I feel a bit sick today, so if I'm like weird, that's why. A little under the weather. Thanks.
Angela, I don't think I know anybody who is as thoughtful and as composed as you are while sick as you. So I really don't think there's any need to apologize. But thank you all so much for sharing your own investment stories and really helping us to see that there is such a pluriverse of opportunity out there. And so much of it is grounded in what do you want your money to do? What do you want your money to do? What do you need your money to do? And then how can all of that be tied into some of those guiding questions that Taj started us off with, is like, at the end of the day, how are we all investing in community wealth building? Whether it's with our dollars, whether it's with our relationships, like you were alluding to, Ginny, or something else entirely. So I really appreciate the stories and the candor with which you've approached this conversation today. So we actually have a sizable time for Q&A, which is very exciting. So I've been tracking some of the questions that have been coming in the chat, and then I also have some that folks have sort of pre-seeded in their registration forms. So as folks are kind of thinking about what additional questions they have, I'm going to kick us off with more of a general one, and then would love to open the floor to anyone on this call who has a question for our kind of panel of experts here. So the first question that I'm thinking about, let's see if I can reload my list. Okay. So I really liked this question that someone submitted in their registration form, and I think it's really resonant with some of the elements around positionality that you, Angela, and you, Jasmine, shared earlier. So I'm just going to read it verbatim. So someone wrote in, "Often I have great conversations, but I'm blind to macro issues affecting the whole sector, increasing my risk in ways I might not be aware of. Other than diversifying, are there any good ways to catch myself from being swept away by people passion and build in some perspective?" So I asked this question because, I feel a lot of resonance with that question, and trying to really understand, there has to be a strategy to our investments, and there have to be ways in which we're honest about our own needs, and as well as the needs of our communities. And also, I was just thinking, Angela, the example you gave of your initial investments, right, where there was this kind of restructuring that happened, and initial stakeholders and shareholders were screwed over, honestly. And so that alludes to some of these maybe macro issues that this individual was sharing about. But yeah, curious to know what comes up for you when you hear this section. And I'll put it in the chat as well, so you're able to read the question again too.
Yeah, I saw this one in the prep, and I thought, man, that is such a deep question. Even after doing this for 20 years, and we have a chartered financial analyst on our team and a CFA candidate who are arguably some of the most knowledgeable people on macroeconomics. I see the level of labor and time and thought that they have to put into wrapping their head around what's going on in the world around us, and just distilling it down for the rest of us on the team who are not CFAs, that I think it's unrealistic for us to even really understand all the machinations. Like, and when I say us, I mean I'm with you as like an average person. I think it's really difficult. So one of the helpful tools I found was this book I put in the chat, The Most Important Thing by Howard Marks, which I found to be really centering in terms of like what is actually important to pay attention to, all relative to the public markets, none at all impact driven in the commentary, but just from a pure like economics and investment selection process, what is helpful to pay attention to. And he really distills it down, I think, in a much similar a simpler format that's digestible for most people. Hopefully you'll find that helpful.
Can I add something? Because I think one of the things that we make a mistake in doing is that we think we have to figure this all out by ourselves. And there's actually a lot of power, particularly for women, because this is how we like to learn sometimes, in learning alongside with other people. So don't think you have to go do this all your own. Don't think you have to know everything yourself, but find other people who are like-minded and put a little group together and talk about this stuff. Share your ideas, share your research. I think another really important thing to consider when you're thinking about your money, in addition to the things Nairuti mentioned, which are like your goals and what you want your money to do and what kind of impact you have, is how much time do you have? So the time question is really important. When I was part of these angel groups doing direct investing, I had a lot of time to offer it. And then I wrote my book, and then I started a nonprofit, and then I had no time. And so my ability to engage completely changed. And so being honest with yourself about the amount of time you can put into this will be important in helping you decide whether you want to do direct deals or you want to go through some of the funds. And Taj put some great links in the chat about some ways to find funds.
Thanks, y'all. I'm seeing another.
Just to
Yeah, please.
just to build on something that Jenny said, I think, you know, a lot of this can be overwhelming. So I think, and Angela as well, like, find an easy way to just get started. Like, put a little bit of money aside that you can afford to lose, and just, as Jenny said, like, start building a relationship. Invest in a relationship you have, right? And I think what's so powerful for me in the stories that I heard were just about, yeah, the power of relationship, like the coffee shop down the street, or your neighbor, or there's just yeah, I just was really moved by the ways in which, in all the stories that you shared, people were thinking about how to move resources in the places they live, around the things they care about, in relationship to the communities that they're committed to. And I think just find a way to get started doing that. And there's small ways to get started, but just get started. And as we just shared, it's just that's where the learning happens.
Thanks, Taj. There was a question that came in the chat very recently, and I think I like this question a lot because even after the AMA we hosted in December, we had a lot of folks follow up about, what if you need to care about the rate of return for your own self, for your own family? And so the question I want to pose to this group, that was from someone in the participant room right now, is what if you are working 2 full-time jobs to make ends meet and are interested in investing to alleviate some of that financial strain? I'm assuming personal and familial financial strain, but still want to invest in the things that matter, or at the very least are not actively funding atrocities. So curious to know how you would respond to something like that.
I think one place to start, where there's been a lot of work, if you look at, Addison Social Capital, Change Finance, there have been kind of innovators in the public market space, and there are just a few who really who spend their time and resources thinking about how to ensure that in public markets your resources aren't going into things you don't want them to go into, are going towards things that you feel better about, and you're going to get market rate returns on public market investments. And those opportunities are in the marketplace, and you can, with a certified financial planner or a registered investment advisor, you can see how these things are performing, how those products are performing. And for folks who've got significant resources in that, I mean, as Angela said, some folks are trying to figure out, can I put 5%? They shift 5% from Wall Street to Main Street. Can I go from 5% to 20%? Angela is like, I've got 6% in public markets. I got 94% invested in community, right? So each of us are in a different place in terms of our capacity to allocate resources along that spectrum. And wherever you are is wherever you are. So don't just do the best you can from where you are in community with support. Don't try to do it alone. The collective wisdom will guide you, but I think this may be controversial, but I will say, like, the people who've been working on this for a while have kind of squeezed most of the value you're going to squeeze, the impact value you're going to squeeze out of public markets. Most of the time, and those products exist. They've been refined. You can monitor their performance over time. That's not where the interesting learning is at right now. So those things are available. If you go to Angela, she can help you find some of those things. You go to Candide, they can help you find some of those things. The folks who can help you find that. So I think that's more of the known side of the equation at this point. It's in direct investments and community investments where there's still a lot of learning and happening.
So I'm going to give a slightly different spin on that, and realize that if you've ever heard of anything called financial archetypes, which are definitions of how we show up around our money, I have for a long time been a guardian, which means I'm really, really careful with my money. And I am, because I spent the vast majority of my adulthood thinking I was going to end up 80 years old living under a bridge eating cat food. I mean, I really had bag lady syndrome, and it wasn't until recently that I let that go. So I've been really cautious and really careful about the way I invest. And I have grown my wealth. I mean, I really have. And I really stand behind the belief that you do not have to give up financial return to invest your values. I also think that there is a portfolio approach where you can say, this is the bucket of money that I really need to grow. And you're going to have to make choices around its growth potential and how perfect your investments align with your values. So I'm really a believer in perfect is the enemy of, the good, and that you can find a middle way, even in the public equities, the stock market. You're not going to get to perfect. There are some things that help you get close, but you're not going to get to perfect in terms of the financial return that's really market rate or above and values aligned, but you can get a lot better. And then you can have other parts of your portfolio where you say, you know what, this is where I'm going to take a lot more of my risk. This is where I'm going to go out on a limb more. This is where I'm going to have a more concessionary return. This is the part of my portfolio where I'm going to do something that is different. So you can make choices within that spectrum. And I think Taj is right. There's a real spectrum here. So there's me maybe on one side that's like, I want market rate return from almost all of my investments. I've done some in real estate recently and other things that are very risky and not going to give me market rate return, but they're going to do amazing things in the world. And then there's the other side of the spectrum where Angela is more likely sitting, where she's like, I'm not even in the public markets at all. So you can fall anywhere in that spectrum that works for you. And it's really wide and it's really broad, and there's a lot of choice within it. So I think that's just really important to think about what's important to you and what your needs are.
Thanks, Janine. Jasmine, I think I saw you unmute, so wanted to give you some space too.
Oh, thanks, Nairuti. Yeah, this question is super dear to my heart. It's kind of one of it's an iteration of the question that led me to go down this journey of writing this book for the past few years, because among my peers, kind of folks in that like 18 to 35-year-old range, folks who are building, wealth for the first time, especially from communities of color who are thinking about the ways in which we want to support our families and build generational wealth. Like often the question, it does feel like there is this tension between, how do I support myself today and pay down student debt and survive and help build the next economy that I know that we deserve, right? And I feel like for so long, we have been put in this tension where we feel like we have to choose. And I just want to name, like, even just beginning to acknowledge that tension and do some of that myth busting is a really powerful place to start. And so to that question specifically around, just actually taking a step back, the fact that someone has to work 2 full-time jobs to make ends meet is evidence of a system failure, right? So let's start there. When we're talking about investing and investing in, community wealth building, for people who are in those positions, we also need you to invest in yourself. Because often, for so many of us, we hold shame and resentment, especially when we're holding positionalities and maybe watching others in our community going through, worse financial situations than us, where we feel like we cannot invest in ourselves to the full extent because we feel like there is like this moral battle that we have to choose. And so in my book, I go into like really concrete details and examples of just navigating those tensions and approaching it from a trauma-informed lens of the ways in which under capitalism, we have to navigate these contradictions. And so in order to do so, making sure we have community to actually talk through what those everyday circumstances are. So for example, let's say that, on one hand, we could be making sure that, I found out a stat that it was like almost 40% of people who work full-time jobs have access to a retirement account that has matching from their employer, but actually don't know about it because their employer has no incentive to tell them that that option is available to them. So actually taking the time to ask your HR person, am I entitled to these benefits? And then leveraging it and then telling your coworkers and having your coworkers ask their friends and family who are also in similar positions is a really powerful first step to reclaiming wealth that you're already entitled to, right? So that's on one like really practical of investing in yourself. On the other hand, how can you join collective movements that are going to be pushing the needle on doing things like debt forgiveness for student debt? So thinking about the debt collective, which is approaching from the perspective on a macro level of, you know, our debt is a liability individually, but when we collectivize it, it's an asset, right? That's actually an amount of power that we can use and wield, but enough people aren't told that they have that power to come together. So I could go on a whole on a whole kind of long, piece around like what are the individual and collective parts, but I think just encouraging folks to like lean into your positionality, like you are an expert in the reality of what it means in a financial system to have to work 2 jobs to make ends meet. Right. And you are the type of people who should be informing what a just investing and financial system should look like. So being involved again on the personal and community care as well as the collective organizing is a really big part of what financial activism is all about. So I'll stop there.
Thanks so much, Jasmine. Such helpful fodder for the ways in which we want to reimagine our entire economic system. And a book that I just pulled off my shelf. I don't know if folks have read The Working Poor. This was sort of one of the first forays into thinking about how is it that someone is working 2 full-time jobs, for example, and still not able to meet ends meet. And I totally agree with you. It's not just a system failure. It's also like the system is working in the way that it was supposed to work. Like this is all by design, and the shame and whatever other emotions come up personally from that context, many of which I myself have experienced and have seen my mom and dad experience, they're just they're in response to something much greater than ourselves. So I just want to amplify that as well. So I have one question that's going to veer us a little bit more into semantics, but Taj, because you mentioned Adesina in particular, a question that we received kind of in the registration process for this event was actually about one of their ETFs. So I'm just going to read the question. It's, I have been incrementally investing in Adesina's Social Justice All Cap Global ETF. What due diligence processes do you recommend for delving into their portfolio to identify a few investments in which to directly invest? And I think I like this question because, this is just one of many other similar types. I know you mentioned change finance, Taj, but this is a great kind of case study in like, how do you really get into that portfolio and understand what's going on in there? And then go the route of direct investing, which many of you have mentioned is kind of a good way to invest your money. So would love to open the floor there.
Yeah, I think just to kind of pivot the question a little bit, I personally wouldn't I wouldn't use a public market ETF as a mechanism to find a direct investment. I would talk to Jenny, I would talk to Angela, I would go down the street and talk to, I would talk to the small businesses in my neighborhood. And if you're, I would, sort of more Janie's experience of like, I would get into a circle of other investors and start doing angel investments and see how angel investments can sort of take you into from angel to, so I wouldn't necessarily go down that path. There's stuff in there. But if you're looking, it wouldn't be the path I would take necessarily to find those direct investment opportunities. I don't know if other folks have thoughts on that.
I can comment on this a bit, and also I'd love to address the 401k questions that has come up in the chat and the pre-submissions. Funds like Adesina have got 600, 700, 800 positions in them, and it makes it really overwhelming to try to wade through all of those companies. Also, I love Adesina, big fan. Not an investment recommendation, but big fan of theirs. but them, like most ETF fund managers, not all, but most, are using exclusionary screening to narrow down the universe of companies. And inevitably, I tell folks that are investing in the public markets, once you dig into publicly traded companies, you're inevitably going to find something you don't like or something that doesn't align with your values. And so a lot of these ETFs will have positions in them that passed through the screens that the ETF managers selected, but those are not necessarily your screens. And so it's very likely that you could be in an ETF like this and still find companies that are violating your values, because your values are your values. It's a lot easier, I think, in a public market sense to go the other direction and to pay attention to corporate actors. And when you see good behavior, when you see them standing up for something that you believe in, that you want companies to be standing up for, to then take the opportunity to dig in a little deeper to see if you can find a reason why that would not be a good company for you. It's a little bit easier that way, and it works a bit better, I think, for folks who really want to have a connection to the investments in their portfolio, because now I'll use the example of NVIDIA, again, not an investment recommendation, but in NVIDIA, back in Revalue's early days, we did discrete stock investing instead of ETFs because there really weren't ETF options back then. So we had to construct essentially a direct indexed ETF for ourselves. And NVIDIA made it on the list because of how they treat their employees, because they pay for IVF and they pay for adoption and they pay for, a lot of, gender transition healthcare. They pay for a lot of things that most companies don't. Then AI happened and it went through the roof, right? Which was great for all the people that were invested in NVIDIA. But a lot of people, we could be like, hey, do you play video games? Yeah, NVIDIA's in your tower. Like, that's a company that's affecting your life right now. So that's a little bit easier. To shift a bit to the 401k. So a couple of people have asked about 401k providers. The two that I know of that are out there is Carbon Collective and Just Futures is launching. They're not live yet, but those are two that I would go check out as 401k options that get a little bit closer to impact or values driven options inside of the portfolio. Definitely a market opportunity for 401k providers to come into the market and shake things up there. And then someone had asked about the match and like, hey, should I take the match even if it's like not the things I want to be in? Does it help me get to the things I do want to be in? You know what? Matches are free money. If I walked up to you and was like, here's $100, you don't have to do anything for it. You just have to like put your $100 over here. Yeah, it sucks that you got to put it into a thing that you don't necessarily want to be in. But as soon as you leave that employer, you do have the opportunity to roll over that 401k into an IRA, and you could do a self-directed IRA and you could get it into the things you want. So I always like to think about matches as just straight up free money, and it's hard to pass that up. If you really don't want to participate in the market system, hold it in like the treasuries fund inside of the 401k. It's not going to earn you as much, but at least you're, it gets dicey there too, because now you're like back in the military industrial complex. But anyways, at least you're not involved in like the corporate, nastiness that's happening right now.
And I'll just add to that, most HR professionals working at large companies are like all of us. They're burnt out, tired, and like aren't going to do things that are outside of their job description unless they're asked to, right? So that's where the power of employees actually going to their HR or going to whoever's in charge of their retirement accounts at their company and saying, I want a mission aligned or values aligned investment option or ETF in my portfolio. The more people you have organize and do that, the more people you have just kind of putting that in their ear and saying, we want these options as that we are entitled to, the more likely they're going to actually do it. And so that's what I was referring to in the chat when I was saying, if folks want to email me directly, I'm happy to send just like, there's a passage in my book where I interview someone about that process. So they go through the steps of like, here's the questions I ask, here's how often I asked, and here's how we eventually got to integrating. In this case, it was the NIA Impact Capital that Janine just pushed into the chat. So yeah.
Some ain't no power like the power of collective organizing. Thanks, y'all. Gosh, there are so many other questions I want us to get through, but we have 5 minutes, and I think this one might be a good one to kind of take home, especially since we've been talking so much about doing this work in community. So this question came in from Jamaica in the chat. And they write, I'm seeing funding circles pop up in some of the communities I serve that do not find funding accessible for the small businesses in their community. What advice would you give these folks on first steps? And then I'm just putting it in the chat so y'all can see that question. And then we'll wrap up in about 2 to 3 minutes, and then I'll close us out.
I hate to say this, but be careful about the legal issues. The good news is there is such a thing as an investment club, where if everyone puts in some money into something and everyone is involved in making decisions about what to invest in, the investment that is made by the club members is not considered a securities offering. So that's something you can Google on the SEC website. They have a whole thing about investment clubs. But don't forget that whatever you invest in, that thing also has legal responsibilities to comply with the securities laws. And it would be sad if you invested in something and inadvertently caused that business to violate the law, which could create risk for them in the future. So it is worth kind of just making sure you know exactly what's allowed. And every state is a little bit different in terms of securities law. So some states, there are great rules that make it quite easy to do direct investing. So yeah, just check out your state and federal securities laws before going too far down this road.
And I know this is a call about community investing, but again, broadening our definition of investing and the ways that we support one another, I really advocate for the lower risk, potentially lower risk opportunity of forming local giving circles. So giving circles are philanthropic capital, right? So donating money that you're not expecting to get back. But what's really cool there is if you're able to have a fiscal sponsorship or form a, partner with a nonprofit, you can leverage corporate dollars to do some matching. So I've seen some really cool things where just local people here in Oakland or in their local community come together to raise funds for, AAPIP is a really great example of the National Giving Circle Network, where they can raise funds just from community members and then have corporates match those dollars that they can then donate to support different initiatives. So again, free money and leveraging that free money whenever possible.
Yeah. One other kind of pathway I'll mention is increasingly folks are doing impact investing through donor advice funds. So there's groups like Realize Impact, Impact Assets, LOHAS Advisors, Movement Strategy Center, where I'm on the board, does this through their DAF, where you can individually or as a group pool philanthropic resources and then deploy grants and debt and equity investments into community investments, and all of the returns, if there are returns, flow back into the DAF and can go out in an integrated capital way. So there's more. That's another pathway to kind of collectively come together and move resources through infrastructure that's well monitored and regulated.
All right, folks, that actually brings us right to time. Thank you all so much for participating in this event, for asking such thoughtful questions. Everyone who's registered for this event will receive a few things in your inbox. So a recording of this event that you can share freely and widely with your network. I'll be looking through this video and through the chat and throwing together a resources and offerings document with all of the links and resources and things that were shared during this conversation. So if you weren't hurriedly taking notes, don't worry, everything will be compiled for you. And then, in case folks are interested in staying in touch with the folks on this group, I'm throwing our email addresses in the chat in case folks have follow-up questions. And then last but certainly not least, as a sort of thank you for attending this event, and also a plug for the next egg, of everyone who has joined this event receives a discounted rate if you're interested in joining an online community with folks who are asking similar questions and things of the like. So again, thank you so much to all of you. A deep bow of gratitude to our incredible panel here. And we're looking forward to staying in conversation with all of you as we think about investing in community wealth building in the many, many years to come. So thanks y'all so much for joining.
Mahalo, thank you.
Thank you.
Thanks, Nairuti.
Thank you.
That's wonderful.
Thanks for putting this together.
Thank you.
You did a great job.
Thanks.
And Taj, I
Take
love
care.
I love your enthusiasm for this kind of
Hold on, let
investment.
me pause the music because I think someone is
Yeah.
talking to me.
Yeah, it's exciting. It's exciting because I think as someone said in the chat, the community of people who are, there's people like you who've been, at this for a while and learning and writing books and organizing circles and bringing other people into it. And it just feels like the community is getting bigger and bigger of people who are really wanting to figure out how to do this together. And I think,
Yeah, I agree.
think
In
this-
fact, one of the things
this-
I've been
this
thinking
storytelling.
about. So somebody brought up the whole retire big oil thing. You guys are familiar with that. So I was so impressed by what they pulled off. Do you know that they got 27 million people to view that thing? It was impressive, right?
That's very impressive.
I've been thinking about that, and I thought there are all of us out here are trying to get people to think more about investing their values, and we're all kind of saying it in our own little silos. And so I'm starting to think about what if we took a page from what they did and we all joined together and we did something related to this kind of investing in a really big way. So stay tuned because I have a call I have the call with the two people behind it. I think next week, either tomorrow or next week, I forget what day, but I'm going to find out how it worked, what they did, how much it costs. And I really think there's an opportunity to do something similar around trying to promote, right?
I think in the context of just like in the fossil fuel space, like divest from fossil fuels, reinvest in renewables, or reinvest in strong local economies, or reinvest. Like it's been a while where the divest side of the equation has been much stronger and much more effective than the reinvest side.
Right.
Even where resources are being divested out of things that are really horrible, they're not necessarily being reinvested in
as
the
much
things that would so I think what this conversation is about, and the moment that we're in, is can we make, there's a couple things. Can we make reinvest as simple and clear and compelling as divest? Because there's a way in which the divest is like simple, clear, and compelling, right? It's easier to say no than it is to say yes, because the yes options are more expansive, right? It's just so I think that's kind of the